Want more return than an FD? Understand the real strategy to make money in the share market. A man is standing at a bank counter. He has put his savings into an FD, and he knows exactly how much money he will get upon maturity. Everything feels safe, but a question is pricking him from inside. At the same time, his friend shows him a mobile screen. Some stocks have multiplied several times over a few years. The friend smiles, but behind the screen lies a story of red candles, panic selling, and losses. Right from here, the fear begins. Money feels safe in an FD, but the return is limited. In the share market, the return can be big, but one wrong decision can shake the capital of your hard work. The question is precisely whether one should jump into the share market to earn more money than an FD, or first understand the rules of that game, where reward and risk go hand in hand. Today, the investing atmosphere in India has changed. Demat accounts have reached crores, SIP contributions are in thousands of crores every month, and discussions about the market have reached even small towns. But an increase in the crowd does not mean that everyone will make money. Entry into the market has become easy, but creating wealth still demands patience, knowledge, and discipline. Understanding an FD is easy. You give money to the bank gives a fixed interest, and upon maturity, you get the interest along with the principal. The risk is relatively low. The share market is different. Here, you buy ownership in some business. If the company grows, profits increase, and management is good, the share price can go up. But there is no guarantee. In an FD, the return is almost fixed in advance. In the share market, the return is made or broken by business performance, valuation, the economy, interest rates, global events, and investor sentiment. That is why treating the share market as a direct replacement for an FD is dangerous. An FD gives stability, equity gives growth. Both have different roles, and a wise investor recognizes the place of both. If you do not have an emergency fund, putting all your money into stocks is risky. In times of illness, job loss, or sudden expenses, you might have to sell shares during a market downturn. The first rule is precisely to invest only that money in the market which is not needed in the short term. Money required in 3 months, 6 months, or a year should not get stuck in equity. The share market is powerful for wealth creation, but it is not a machine to get rich quickly. It can also become a system that takes money from impatient people and rewards patient people. Now the question comes, how to earn a higher return than an FD? The answer is not by taking more risk, but by taking a calculated risk wisely. The most important thing in the market is research. Which company to buy, why to buy it, what its business is, how profit comes, and how much debt it has. It is essential to understand this. If you buy a stock based merely on a friend, a Telegram channel, or a social media tip, you do not remain an investor, you become a gambler. A tip can give you an entry, but not conviction. Conviction comes from research. An investor has to form their own reason by looking at the annual report, quarterly results, management commentary, debt levels, cash flow, industry trends, and valuation. A company can be good, but the share can be expensive. In the market, both quality and price matter. Even a good business can become a bad investment at the wrong price. This is where the importance of valuation comes in. Indicators like the PE ratio, price to book, earnings growth, and return on equity show how much expectation the market is placing on the company. But decisions should not be made by looking at ratios in isolation. Banking, IT, consumer, capital market, and manufacturing companies have different natures. The valuation logic of every sector can be different. Direct stock picking can be difficult for a beginner investor. In such a situation, index funds and diversified equity mutual funds can provide a disciplined route. An index fund follows an index like the Nifty 50 or Sensex. In this, you do not rely on a single company, but on a basket of several large companies. The benefit of an SIP is precisely that you escape the pressure of market timing a little. A fixed amount is invested every month, sometimes when the market is high, sometimes when it is low. When the market falls, an SIP can buy more units for the same amount. When the market rises, the old units can gain value. This is the simple logic of rupee cost averaging. But an SIP is not magic either. If an investor stops the SIP upon seeing a downfall, the biggest benefit is lost. Long-term discipline is the real strength of an SIP. Timing risk is higher in lump sum investing. If you invest a large amount at the market top and the market falls, mental pressure can increase. Therefore, investing a large amount slowly can be wise. This is called staggered investing, where money is put into the market at different times. The buy-on-dip strategy is popular, but it does not apply to every falling stock. If a quality company falls due to a temporary problem, it can be an opportunity. But if a weak company is falling continuously, debt is increasing, and the business is breaking down, then that is not a discount. It can be a trap. Every cheap stock is not a value. The greed for penny stocks is very dangerous. Looking at a low price, people think that if a 5 rupees share becomes 10 rupees, the money doubles. But a low price does not mean a cheap valuation. Many penny stocks have low liquidity, limited information, and the risk of manipulation can be higher. The price goes up with a single message, and during exit, the buyer disappears. Real wealth in the market is often created by boring businesses that provide profits, cash flow, and growth for years. Excitement comes in the short term. Compounding is built in the long term. Compounding means making a return on a return. If the company keeps growing and the investor keeps patience, even a small amount can become big over time. But survival is necessary for compounding. If an investor loses capital in high-risk bets, compounding finishes even before it begins. Therefore, building a portfolio is necessary. Putting all your money into just 1 or 2 stocks is dangerous. Diversification does not eliminate risk completely, but it can reduce the shock. A balanced investor keeps exposure in different sectors. Risk can be spread through banking, IT, consumer, pharma, manufacturing, or index funds. But over-diversification is also a problem. If you have 50 random stocks and you do not understand any of them, the portfolio does not remain a mutual fund. It becomes a confusion. A focus on quality is necessary. The risk of losing money in large and established companies can generally be lower compared to small speculative stocks, but zero risk is not there either. Large cap companies can provide stability, mid caps can give growth, and small caps can bring high volatility along with high potential. The allocation should match your risk capacity. Risk capacity does not mean just mental courage. Your income stability, age, dependence, loans, emergency fund, and investment horizon also determine your risk capacity. If you are 25 years old and your income is stable, the equity allocation can be higher. If retirement is near, capital protection can be more important. The role of an FD does not end here. FDs or debt funds provide a cushion to the portfolio. In a market crash, this very safe portion can protect you from panic selling. The second key to earning returns in the share market is the time horizon. In the short term, the price moves on mood. In the long term, the price often follows earnings. If a company is increasing profits, debt is manageable, and the industry is growing, it gives a long-term investor a reason to tolerate volatility. Mixing trading and investing is dangerous. In trading, price movement, stop loss, and speed are important. In investing, business, valuation, and time are important. Many people buy a stock in the name of investment, and when it falls, they say they will hold it for the long term. In reality, this is an unplanned trade that becomes an investment out of helplessness. Decide the exit rule before entry. If the company's business thesis goes bad, management issues arise, debt goes out of control, or valuation becomes unreasonable, a review is necessary. Profit booking is also a part of the strategy. If a stock runs very fast and becomes a very large part of the portfolio, partial profit booking can reduce the risk. But booking profits too early can also stop compounding. An investor who sells at every 10% gain can miss a journey of major wealth creation. Therefore, the question is not when to sell. The question is whether holding is still logical according to the company's future growth, valuation, and your goal. Fearing a market correction is natural. But every downfall is not a crisis. Sometimes the market books profit, sometimes it falls due to global fear, and sometimes the valuation cools down. A smart investor looks at their watch list during a correction. They keep good companies identified in advance so that they can take a well-thought-out action even in a panic. But even in a correction, the entire cash should not be deployed in a single day. Nobody knows in advance which day is the market bottom. To get a higher return than an FD, it is also necessary to understand tax. FD interest is taxable. In equity, capital gains taxation is different, and the holding period matters. Tax rules can change, so an investor should check the current rules. Making a comparison simply by looking at the pre-tax return is incomplete. Inflation also silently eats the value of money. If the FD return left after inflation and tax is very low, real wealth can slowly weaken. The purpose of equity is precisely to get better growth than inflation in the long term. But this growth does not come in a straight line. Rather, it comes with ups and downs. Many times, the biggest enemy in the market is not the market, but the investor's behavior. Greed makes them buy at the high, fear makes them sell at the low. When profit screenshots are visible all around, people take entries without research. When the market falls, those same people exit at a loss and swear that the market is bad. In reality, the market is not bad. Behavior without a strategy is bad. To create wealth, rules must override emotion. There is a simple rule. First, write down the goal. House, education, retirement, wealth creation, or short-term need. Every goal has a different time horizon. Then decide the asset allocation. How much money will stay in equity, how much in debt, how much in an emergency fund, and how much in a cash reserve should be decided beforehand. Then choose the investment route. For a beginner, an SIP in index funds or diversified mutual funds can be easier. An experienced investor can do direct stocks along with research. Then make a review schedule. It is not necessary to look at the price every day, but it is necessary to review the portfolio once or twice a year. In the review, see whether the portfolio matches the goal or not. Ensure a stock is not being held just because of an old attachment, and check that a sector has not become overweight. You will get a lot of advice in the market. Someone will say this is a multi-bagger. Someone will say a crash is about to come. But your money is your responsibility. It is better to take guidance from SEBI-registered advisors and credible sources. One should keep a distance from unregistered tip providers, guaranteed return schemes, and secret stock groups. Guaranteed high return is the most dangerous phrase in the market. There is no guarantee in equity. The one who sells a high return by giving a guarantee is often hiding the risk. Earning a higher return than an FD is possible, but in exchange for that, uncertainty has to be accepted. An investor who cannot tolerate volatility may find a high equity exposure difficult. Therefore, keep the beginning small. First, understand the market, learn with a small amount, and treat mistakes as a tuition fee, but do not experiment with a large amount. Gradually, when confidence, knowledge, and discipline increase, the allocation can be increased. Investing is not a race, it is a marathon. Some stocks, like BSE Limited, gave extraordinary returns in previous years, but such examples look easy in hindsight. Identifying them beforehand is difficult. Stories like Rolta have also been in the market, where there was excitement at one time and later investors had to face heavy losses. Therefore, do not take an entry simply by looking at the past return. Shares of any group or company can fall after bad news and can recover too. But every fallen stock does not come back. This is the reason why risk management comes before return. If capital is saved, opportunity will come again. If capital is finished, you will be out even while the market remains open. To create long-term wealth, boring habits are needed. Regular investing, an emergency fund, diversification, low debt, realistic expectations, and patience. An FD gives you safety and predictability. Equity gives you the possibility of growth. Smart money does not make the two fight, it makes the correct use of both. If the goal is for 1 to 2 years, an FD, debt, or safer instruments can be more suitable. If the goal is 7 to 10 years away, equity can play a meaningful role. The secret to earning a higher return than an FD from the share market is no hidden formula. The secret is the right company, the right price, the right horizon, and the right behavior. The market will test you every day. Sometimes it will increase greed by giving a profit, sometimes it will scare you by giving a loss, and sometimes it will check your patience by giving nothing for months. The investor who does not leave their strategy in every test slowly begins to understand the market. The return goes only to the one who respects the risk. In the end, the matter is simple. The share market can give a higher return than an FD, but it cannot give a guarantee like an FD. Therefore, invest through a system, not through greed. First learn, then make a plan, then take small steps, and then let time become your partner. Because wealth is not created by a single day's boom, but by years of discipline. And remember, the one who makes money in the market is the one who does not break down in every downfall, does not get carried away in every boom, and ask themselves before every decision, why am I buying this stock?
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.